morning. Good morning, ladies and gentlemen. Welcome to the fourth module of the 2024 DTB KBA Financial Literacy and Enterprise Development session. Karibuni sana. Thank you for joining and thank you for your commitment for being here all through. Today's session is on taxation for SMEs, and we know this is one of those topics that was highly requested. We also remember some of the questions that came up from last week's module on legal requirements in business. We had lots of questions around taxation, so it's going to be quite an interesting session today. So karibuni. And as usual, let us know if this is the first time you're joining our sessions, what you have picked up from previous sessions, and where you're joining us from. As always, we are very interested and keen on getting to know you and to understand your businesses a little bit more. So, karibuni sana. Welcome, ladies and gentlemen. We do have our sign language interpreters today, Victor as well as Abigail. I'll also be sharing the same on the chats. So please be sure to take note of that. Thank you so much for joining, ladies and gentlemen. So allow me to introduce our trainers for today. We have on the call RSM Limited, RSM Eastern Africa Limited. They are a powerful network of assurance, tax, and consulting experts, and they have offices all over the world. They have grown into Kenya's leading professional services firm over the last 20 years. And so they are very rich in experience, and they will be taking us through the tax landscape in Kenya, the emerging trends, and what to look out for in the space. They are operating in 120 countries, and they have over 820 offices. They are, in fact, our tax consultants, and so we are very glad to have you listen in to the insights that will be shared today. And so even as we log in, please feel free to also share maybe some of the insights you're looking forward to in terms of the tax landscape, and we shall have a representative from RSM responding to the questions. So allow me at this point to welcome Josephat Karanja, who will introduce the team a bit more and give us some background into RSM, and then begin the session. So as always, there's a Q&A tab at the bottom of the screen. Please address all the questions to the Q&A tab, and then any comments can now be addressed in the chat. Other than that, welcome, ladies and gentlemen, and let's dive right in. Karibu sana, Josephat.
Thank you so much, Mantui, and good morning, ladies and gentlemen. As I've been introduced, my name is Josephat Karanja. I'm a tax consulting manager at RSM, and it's a pleasure to meet you all in this session. You know, tax is a very interesting topic, and as someone says that there are only two things sure in life, and that is death and taxes, I think it was mostly and more appropriate that we have this conversation today morning. Yeah, and I'll first begin with an introduction of RSM as a network. We are the 6th largest global network offering assurance, tax, and consulting. And we are based in around 120 countries, and we have 820 offices around the globe with around 64,000 people. And our global revenue is currently at around 9.4 billion. That is our global fee. And on to our technical capabilities. As we've said, we offer audit and assurance. So the firm is full IFRS and FRS for SMEs. And that is looking also at the one we do have. We have several others have been listed there as a firm. And this is an indication of the capabilities that we do have as a firm. On to our leadership, and this is the regional leadership of RSM Eastern Africa. We have various partners and directors who lead the practice. In Eastern Africa, we operate in 4 countries, that is Kenya, Uganda, and Tanzania. And in Kenya, we do have 2 offices. One in the Nairobi is the Nairobi office, and one which is the Mombasa office. Our leadership is basically composed as you can see on this slide. We have Ashif Kasam, who is our executive chairman. And we have Lina Ratanzi, who is our group CEO, who also heads the Tanzania office. We do have John Walabieki, who is our partner in Uganda, and Nila Mazrui, who basically oversees the Mombasa office. We do have Elvis Ogeto, who is the partner in charge of the Nairobi office, and the other partners will include George Mutua, and we have Kaniz, and we have our head of tax, who is Jill Nasha, who is the tax director in Kenya. We have Meet Sinai, who is also an associate tax director in Tanzania, and we have Simon Fisher, who is a consultant. Basically, these forms part of the leadership of the firm. Our key experience is vast into very many sectors, and I know these are the major sectors that we might have in the economy. So feel safe to approach us in any of these sectors or even others that are not listed here. This is just a brief description of the services that we offer, mostly assurance, management consulting, tax services, risk advisory, transaction advisory, and outsourcing, which is basically the business process outsourcing. So we do have those accounting functions within RSM. Without further ado, I'll just go straight to the topic of the day. And basically, we are looking at navigating the tax landscape for an SME in Kenya. And just a brief introduction, and as we may know, the governments that are coming in, we are seeing a lot of changes always coming in, year out, mostly are driven by the urge of the government to increase the tax base in terms of looking at the budgets that we do have to finance as a country. And in the recent past, we've seen the government trying to expand the tax base to cover most people in the informal sector. And these mostly would be the SMEs or even those in the formal sector. And we are seeing a lot coming in, and especially changes to do with not just taxes, but even other contributions. Like we've seen a transition of NSSF, we've seen a transition of NHIF to the current SHIF. We've seen an introduction of affordable housing levy. So we are seeing a lot of changes coming into the tax landscape. And it is important that we move with the changes because the whole idea is to ensure compliance with taxes. And as you may know, the cost of non-compliance is higher than the cost of compliance. So it would be it is very much advisable that each and every business, regardless of how big the business is, then ensures compliance with taxes to just avoid the additional cost of non-compliance. So we will look at what comes in the preliminaries of tax in terms of on a Kenyan perspective, and basically concentrating on what SMEs find themselves liable to in terms of the obligation that the SMEs would have. I think the very, very first one is always a business registration, and each and every business requires a KRA PIN. Remember, it is a prerequisite for you in terms of when you are running a business in the current days that you will always be required to have a KRA PIN, because it's one of the requirements for most business transactions in Kenya. So before you start any operations, then you will find yourself being required to obtain a PIN. If you're operating as an individual, then you'd have to use your individual PIN. If it's a company, then you'd have to have a company PIN. And again, that PIN is affixed to certain tax obligations, depending on whatever business you're doing. So it is important that you ensure that then on that PIN, then you've adduced all tax obligations that covers your scope of business. The key taxes that SMEs will find themselves paying, mostly you'll find for small companies, you'll have corporation tax, which is basically charged on the business profits at a rate of 30%. That is the resident rate. And the non-resident rate, which is also 30%, as per the Finance Act 2023, and a 15% on any repatriated profits. And one key thing to note is the filing frequency for this. Then you are required to file this annually, basically at the end of the 6th month after your year end. So you might find that corporates do not necessarily have to have the year end as December. So you need to file your returns by the end of the 6th month after your year end. Other payments that we see is you'll be required to also pay installment taxes. So for non-agricultural companies, then you pay in 4 equal installments. That is on the 4th, 6th, 9th, and the 12th month. So you need to pay the installments, and the balance of tax then due at the end of the 4th month after your year end. So those are basically what you see as a scheme for paying corporation tax. Other taxes that mostly will touch on SMEs mostly will be the turnover tax. And this applies to businesses with an annual turnover between 1 million and 50 million at a rate of 1%. So ideally, this turnover tax was introduced as a more simplified method of remitting taxes, especially for SMEs who fall within this scope in terms of a revenue threshold. And this is because in this regime, you do not have to go straight and take any deductions. It's tax paid directly from your revenue. And that is the turnover, which is a more simpler method. It again saves the hassle of having to maintain a lot of documents and to prove any expenses that you might be taking as deductions. So it is due on or before the 20th of the following month. We do have VAT, and this is for businesses that deal with vatable supplies. And the threshold for registration of VAT is still 5 million. We saw the government had an intention to increase this threshold to 8 million through the Finance Bill 2024, which did not see light of day. So the current turnover threshold is still 5 million. And there are 3 rates of VAT. The first is the standard rate, which is 16%. And we do have a 0 rate. Mostly these are goods that are listed in the 2nd schedule, or services also listed in the 2nd schedule. And we do have an exempt rate, which means no VAT. And these are mostly goods and services listed in the 1st schedule of the VAT Act. The difference, I know most of you would be asking, what is the difference between 0 rating and exempt? 0 rating means there is VAT, but at a 0%, while exempt means that there is no VAT. The main distinction in this comes when you are claiming input VAT. You only required by law to only claim input VAT that relates to vatable supplies. And we've said that 0% is a rate of VAT, which means it is a vatable supply. So mostly when you're dealing with 0 rated, you are allowed to claim input VAT, which then means that you'll be left at a refundable position, because if you only deal with 0 rated, it means that your output VAT is 0, but you have incurred some expenses. You have incurred some expenses that have VAT. So you'll always be in a perpetual credit position, which then means a refundable position. When you're dealing with exempt supplies, this means that there is no VATs, which then means that there is consequently no input VAT claimable on that aspect. So you will not be, if you're dealing with the exempt, then you're not also required to register for VAT. So that obligation is not part of the obligations that you should have on items. The other tax that we'll also touch on SMEs will be pay as you earn. Mostly this is when you have an employee. And we know that the tax rates it's through the graduated scale, which ranges from 10% to a high of 35%, depending on the income. This is still due by 9th. I know we'll be looking at other issues to do with PAYE, looking at most SMEs will contract some staff as not employees, but consultants. We'll see what is the difference between the two and what are the risks that the Revenue Authority might pick on that perspective, and what to look out for in that case. Then we do have withholding taxes. Mostly this is tax deducted at the source. And mostly you'll see this is charged on management and professional fees. You might find most SMEs engaging some consultants, legal or incurring legal fees and such. So they do have that obligation to withhold tax on that. So basically, this is tax deducted from by the payer, and you are required to remit this to the Revenue Authority within 5 working days after you make that deduction. So when you make that payment. So other considerations that we'll also be looking at in depth in this engagement today morning is the SHIF. I know this is a hot topic now, and NSSF contributions. So we're also looking at the obligations that employers have in terms of deducting these and remitting to the various authorities in this perspective. So these will also be other consideration we'll be looking at in depth in this training. On a filing perspective, in terms of a reporting perspective, we do have a revenue platform, which is run by KRA. This is the iTax platform. Most of you might be aware of this. So we are looking at what will be required is registration and filing of returns, and this is all returns. Looking at the specific timelines or deadlines to remit those returns. Generating payment slips, so that once you pay, you file a return and it has amounts that are due, you need to generate the payment slips and remit the same to KRA. And also tracking your compliance status. I think this is important. And as I had mentioned, that the cost of non-compliance is higher than the cost of compliance. So it would be proper to always track your compliance status. The Revenue Authority also allows you to always generate a tax compliance certificate, which ideally, when you are applying for that, you can you are able to see any obligations that you have and that you might need to action before you get that tax compliance certificate. It is also a preliminary requirement for some of the businesses to have this, especially when you're entering into contracts. So it will be important that you track your compliance status. There are also tax incentives that are available for SMEs, and you will see, like in terms of capital allowances, there are certain deductions that are allowable to claim over time, especially where you have these huge capital expenditures to expand your business. And other tax favorable regimes, such as the special economic zones and the EPZs. We're also looking at some of them would have benefits to SMEs. And just to ensure compliance, you'll see most SMEs engaging tax professionals, even at the inception of their businesses, to make sure that they are compliant on all stages of their business growth. And you will see them handling and having the tax consultants handle their tax planning and filings, ensure compliance with all other regulations, and this is all in minimizing penalties and interest that accrue from non-compliance, which then results to a tax saving. Remember, the role of a tax consultant here is to make sure that you're only paying your rightful share of taxes, not paying more, not paying less. And again, ensuring that even as your business grows, then you have the correct structure that will optimize your tax liabilities in the future. Also looking at any envisaged transactions that you might be planning to handle in the future or to transact in the future. I think that in a nutshell summarizes what we'll be looking at in depth. And I think I'll just have my colleague James will take us through the employment deduction. I know this is, we'll have a lot of new entrances that we've seen. We'll see the issue of NSSF. We'll see the issue of SHIF, affordable housing, and I know most questions will come about in these areas. So I'll just invite my colleague James to come and maybe present to you what we are seeing, and maybe we can get questions from you on that, on those specific areas. Thank you so much.
Yeah, good morning, ladies and gentlemen. My name is James. and I'll be taking you through employment deductions. And to start us off is National Social Security Fund. You remember that the enhanced rates of NSSF came about in 2023, that was February. So it will be implemented in phases, and we are already in year 2 of implementation, which was effective 1st February 2024. So you'll note that the new NSSF rates are pegged at 6% of gross pay, subject to upper earnings limit, and this has to be matched by the employer. So the employee will contribute, or rather contribute 6%, and the employer matches the same. The contributions are classified into 2 categories, that's tier 1 and tier 2. And you will note that in this case, there are a couple of definitions. We know if you come across national average earnings. This is the wage earnings per employee for each year, as described by Kenya National Bureau of Statistics in their economic survey. There is the lower earnings limit. This is the amount gazetted by the CS from time to time, subscribing or rather indicating the minimum monthly basic wage for the top urban centers in a year. There is the upper earnings limit that is equal to 4 times national average earnings. Also will come across tier 1 contributions. This is tied at 6% of the lower earnings limit for both employer and employee. So there is the tier 2 contributions. These again, for both employer and employee, pegged at that is earnings between lower earnings limit and upper earnings limit. So employers can opt out of NSSF, that is for tier 2 contributions, but now this has to be contributions has to be made to other eligible schemes approved by Retirement Benefits Authority. So the implementation will be on a 5-year period. We are already in year 2. So in year 2, we are talking of the lower earnings limit being at 7,000 Kenya shillings, while the upper earning limit, it's 1 times of national average earnings. So in this case, the amount is pegged at 36,000. So year 3, we are expecting this will kick in February 2025. So we are looking at a lower earnings limit of 8,000 and upper earnings limit of 2 times national average earnings, that is 72,000 Kenya shillings. So you'll note that the second phase, that is year 2 implementation, commenced in February 2024, that is this year. That means the 3rd year of implementation will now start in 2025. That's February. So we have a tabulation of how the amounts will look like. So we have the lower earnings limit for 2023, 2024, and now what we are looking at in 2025. So the year 1 lower earnings limit was at 6,000, which has gone up to 7,000 currently, and we are looking at an amount of 8,000. Upper earnings limit, it's currently at that is 6,000. That's gone up from 18,000, and we are looking at an amount of 72,000 in year 2025. So total contributions at the end of the day will be at 8,640, up from 4,320 currently. And you'll note that that has gone up from 2,160, that is in year, from year 2023. We are saying that employers can have an option of opting out of tier 2 contributions, but now in this case, they have to make a formal request to RBA at least 6 days before opting out or contracting out. They'll have to give details of the contracted out scheme, as RBA may require from time to time. And then RBA within 30 days would respond in writing, indicating its approval or otherwise. And this will be communicated with the Board of Trustees accordingly. Where approval is granted, that's for tier 2, credits would be transferred to the approved contracted out scheme. And then, but now again, you'll note that tier 1 contributions should be remitted to NSSF. As much as an employer has contracted out, an employer can only opt out of tier 2 contributions, but tier 1 contributions will have to be remitted to NSSF. So in this case, there are 2 categories of contributions to be made, that is to NSSF, and then tier 2 to now the contracted out scheme. So there have been a couple of questions that have come about. You note that NSSF contributions will in a way affect the taxable earnings, that is for employees. And there's a limit of Kenya shillings 20,000 per month. We are above that, then the amount would be disallowed for tax purposes. So note that with the enhanced NSSF rates, that will have a direct impact on our ability of pension contribution limits. And when it comes to the tax computations, this should be taken note of, and also when computing the monthly pay-as-you-earn. So another question is, which payroll month will be affected by year 3 NSSF contributions? So this will take effect from February 2025 going onwards. Then another one is, are employers of secondary employees liable to NSSF deductions? In this case, there has to be an agreement by the primary and secondary employers, and this has to be lodged to the managing trustee, indicating the employer who will be liable for the NSSF contributions. In absence of such an agreement, then it means that both employers will be liable individually for the contributions. Then another question is, what are the penalties for non-compliance? The penalties are quite significant. The penalty is 5% every month on the amount that will be outstanding. So that's all about it on NSSF. So the new one is the Social Health Insurance Fund. I will note that the month of October is the first month of implementation. So in this case, we are switching from NSSF and going to SHIF. So in an effort by government to enhance and overhaul the health sector, the government introduced the Social Health Insurance Act. This is to replace the National Hospital Insurance Fund. This is to to promote the agenda of universal health coverage, and again realign health systems, processes, and programs for sustainable healthcare in Kenya. This is a means of pooling resources and risks based on principles of solidarity as to guarantee access to healthcare services. And then again, to promote strategic purchasing of healthcare services. So SHIF again is there. It's a process, and it has got also its fair share of legal challenges. On 30th September 2024, One, Mr. Okiya Mtata went to court and filed a petition seeking temporary orders to suspend the planned implementation. Because now again, the petitioners fought the government for ruling out SHIF program without enacting substantial registration in order to operationalize it. So the High Court is scheduled to have a sitting on 25th October. That's 2 days from today, to decide whether or not to suspend the rollout of the SHIF. So we'll have to wait and see. But as things stand now, it's already in the implementation. So in terms of registration, employers are required to register with Social Health Authority effective 30th September 2024. But you note that for employers currently registered under NHIF, they have the option of validating their details rather than now doing a fresh registration, whereby they'll just use their NHIF login credentials and validate their details. So every Kenyan is required to register as a member. For non-resident individuals ordinarily residing in Kenya are also eligible for registration. For non-Kenyan who intend to enter and remain in the country for a period less than 12 months, they are required to have in possession travel health insurance cover. So in absence of that, then to mean that they will be required to register the SHIF. Now, we have Social Health General Regulations 2024, which were published by the CS Health, which guides on now the applicability of the SHIF. The contributions are pegged at 2.75% of gross salary. And you'll note that this has no upper limit. So the higher you earn, the higher amount of contribution that you make. So the contributions are to be made by 9th of each month, that is the month succeeding the month of deduction. And the minimum amount payable is Kenya shillings 300. So you'll note that SHIF will be contributed by both employed and those ones who are not employed. So for households whose income is not derived from salaried employment, there would be an annual contribution of 2.75 of the portion of household income as determined by, they are calling it a means testing instrument. So this will capture details of socio-economic aspects of individual households. In this case, this will be their ability to pay. So maybe sooner rather than later, you'll find someone knocking on your door just to establish what is your income, source of income, what are assets you might be having, so that now they can determine your capability to contribute to SHIF. And then that will be done on an annual basis. That is for individuals or households that don't derive their income from employment. So there are a couple of questions that are coming forth. So the first one being the effective date. In this case, it's effective from 1st October 2024. So the contributions that will be submitted to the authority by 9th of November will be the enhanced rate, that's 2.75 of the gross pay. So another question is whether the contributions will qualify for relief, as it was the case with the NHIF. Yeah, you'll note that NHIF had a relief of 15% of contributions, which was capped at 5,000 Kenya shillings per month. But now with the migration from NHIF to SHIF, The way the act is worded, it reads National Hospital Insurance Fund. So there would need to be an alignment of law in order to, smoothen and make SHIF contributions to qualify for the insurance relief. So as of now, the law is not very much aligned. So you'll note that the relief in this case will not be applicable. So another question is, with the contributions being at 2.75 of gross pay, will bonuses and other cash benefits be, included in this computation? For now, there are no exceptions that have been provided, and in such case, unless a clarity is provided and or a direction to the alternative, all these benefits will be included in the computation of 2.75 rate. And again, would secondary employees be subject to SHIF? So you'll note that SHIF deductions are based on gross pay. So in a case where someone is employed by more than one employer, then all employers will be liable to deduct the 2.75 SHIF deductions because this is based on total earnings. Then there are penalties for non-compliance with SHIF. Yes, non-compliance will attract penalty at 2% of the amount due for contribution for the period that the amounts remain unpaid. Yeah, another statutory contribution is affordable housing levy. You'll note that AHL was initially introduced by Finance Act 2023, but now again, this was declared as unconstitutional. So there were some few months where the contributions were made through the Finance Act 2023 amendments that by then it was through employment. But now this was declared unconstitutional by Court of Appeal. And that's when the government introduced the Affordable Housing Act, which was again effective 19th March 2024. So currently we are making contributions to AHL at the Affordable Housing Act. So the rate, it's at 1.5% of gross income. And this has to be matched by the employer. Note that unlike SHIF, this one, it's for both employer and employee. Also, for self-employed persons, AHL is also applicable at 1.5% of gross income of the amount income and or accrued. So again, for eligibility of an affordable housing unit, one must be a Kenyan citizen of 18 years and above, and must be in possession of an identity card. I have a couple of questions. One being, is there a relief of contributions to affordable housing levy? Yes, there is. The relief is at 15%. That is when computing pay as you earn. 15% of contributions up to a maximum of Kenya shillings 9,000. Are entities with no employees required to submit AHL? Yes, in this case, entities that have no employees, in that case, they would not be contributing AHL for employees and also matching that amount. Then in this case, they will have to contribute AHL at 1.5% of gross income. And again, are there any penalties for non-compliance? Yes, unpaid levy will attract a penalty of 3%. That is for each month the amount remains unpaid. So with all these changes, now we look at how this will affect your payslip, you see in the current formation where we have NHIF, we are going into SHIF. So currently the effective tax rate on basic pay, it's at for someone earning 35,000, it's at 14.21%. For someone earning 75,000, it's at 23.94%. And someone earning 150,000, it's at 27.89%. You'll note that the rate is progressive because of the graduated pay but. So if we include SHIF into those basic pays, that's that 5,000, 75,000, and 150,000. Now, for the person earning that 5,000, the effective tax rate will move from 14.21 to 16.46. So there will be an increase of around 0.5%. Someone earning 75,000, the effective tax rate will move from 25.94 to 23.94 rather to 25.89. That this mainly is because of the proposed, rather the new SHIF rates at 2.75, because you'll note that in this case, there is no upper limit. For someone earning 150,000, the effective tax rate will move from 27.89, which is the current rate, to 29.96. And again, for higher income earners, that's 500,000, 1 million, and 2 million. The effective tax rate currently is at 30.19, 32.48, and 34.38 respectively. So that will move up a bit to an expected rate of 32.80 for someone earning 500,000. And 35.15 for someone earning 1 million. And again, that's 7.09 for someone earning 2 million. So that's how, with the new SHIF rate, that's how the effective tax rate will look like. But maybe this with, if the law is aligned and there is an introduction of, say, SHIF relief, that will cushion the employed people some bit. And we might see, if that comes in, then we might see the effective tax rate coming down slightly. Yes, now that brings me to the end of the conversation. So we will break for some few minutes. Okay, I'll introduce, I'll introduce my colleagues for a Q&A session for a few minutes. Then we can go to the next conversations of electronic tax register by my colleague Nzioka. So we'll be happy to take questions in the Q&A. So I can introduce my colleagues for the session.
Good morning, everybody. So my name is Nzioka. I'll be answering some of the questions. Now, the first question is whether or not one can totally opt out of NSSF and NHIF. Now, for NHIF, which is now transitioned to SHIF, you cannot opt out. The 2.75% hits irrespective of whether or not you have a private health insurance cover. Now, for NSSF, the only opting out is the one provided you cannot fully opt out of NSSF. Then from a perspective, the second question is who are primary or second and who are secondary employers or employees? And how is this determined at the time of implementation? I mean, how is this, how is the time of implementation determined? So essentially, the primary distinction between a primary and secondary employee for purposes of payroll is the primary employee will first of all utilize your lower tax bands and your reliefs. So they'll essentially pass it through the.
Nzioka, sorry for the interruption. I think there's a
Yes.
bit of a sound. There's a bit of a buffer, so I just request maybe you fix the sound, then we proceed. Yeah.
Okay. Am I audible now?
Yes,
Is it
yes,
better?
yes, that's better.
Okay.
Thank you.
Okay, so what happens is that from a primary and secondary employee perspective, the primary employer is the one who can utilize your lower tax bands and your reliefs. So they'll be able to pass your your income through the 10% and the 25% and the 30% tax bands. They will also be able to implement certain reliefs, such as your personal relief and your insurance relief. The secondary employer will not be able to do these things. Now, it's usually on a first come, first served basis, sort of. So you generally find that if you began your employment with company A, they will generally be your primary employer. Then when you get a second employer later, that will now become your secondary employer. Now there's another question as to whether or not the Social Health Authority scheme is effective. It is effective, and you will be required to make contributions for the month of October at the end, once you're processing your payroll for the month. For employees. Then just further to that, also the court had, with regard to the affordable housing levy, the court confirmed that it was properly passed in terms of public participation and due process, so that will also be fully applicable.
Yeah, okay. There is also a question that asking whether self-employed persons would also qualify for affordable housing relief. Yes, you know that affordable housing is for all contributors, individual contributors. So these would be applicable when computing the tax at the end of the year for the self-employed person, because for self-employed person, they would compute taxes at the end of the year. So yes, they will again qualify for the affordable housing relief.
There's a question regarding the SHIF relief. Now, whether or not it's applicable. Now, the thing is, the current income tax provides for relief on National Hospital Insurance Fund. So it's very specific to NHIF. Now, the Finance Bill 2024 proposed an amendment to factor in SHIF specifically. But given that the Finance Bill 2024 was not passed, then in law, there is no provision currently for SHIF relief. However, we understand that the government may be working on a mechanism to allow for that relief.
I think there is also a question around affordable housing levy, whether it's applicable to those earning rental income. Yes, as long as you've not paid affordable housing levy on your employment income, then you are supposed to pay affordable housing levy on your gross income. So that then means even your rental income will fall under this purview of the AHL.
Yeah, there is also another question. I think there is someone who had paid NHIF until December 2024. Now, what would happen to the payments already done? Because now the SHA gave a circular that effective 1st October 2024, the rates applicable will be for SHIF. So in this case, you might need to get in touch with SHA for that clarity. so that now you are not caught between.
What if you're in a startup and making no income or taking salary with them? Are there any benefits still to be paid? So if you're not making any income, okay, this question is from Nadia Malik. You, as a company, you don't per se have to, if it's your own company, you don't have to give yourself benefits as yet. Meanwhile, the company is still in its infancy. And if there is no income or benefits being accrued from the company, then it would now go that there would be no applicable housing levy, as there would be no income, and also SHIF. But as soon as you start to make income, then as an individual, then that will apply. Now, please note that this is very important to distinguish. That's for a company paying its shareholders. But if it's a sole proprietorship, you need to actually properly assess as to whether or not you're making any income, because any income of the sole proprietorship is your business, is your income.
Could also help ask some questions. So we have Evans Mumbo who asks, if you have a registered business but still not actively in operation, what kind of tax do you need to file?
If you could please clarify as to what you mean by registered business. Do you mean a registered business name?
I would assume, and maybe Evans, you can help us with that clarification. But yes, I think the assumption is a business with a registered name.
So the thing is, as an individual, a business name is more or less you carrying out business as an individual. And in that case, taxes, SHIF and AHL would be applicable.
Yes, but again, if the business is dormant, that I would look at it from a company perspective. If the business is dormant, then you'll have to look at the PIN certificate. What kind of obligations are there? Because you will find that when most business people, when registering for businesses, they will select all ranges of taxes, income tax, pay as you earn, with VAT. So as much as the business is not operational, you will have to file nil returns for all the taxes that appear on the PIN certificate. You can also apply for the activation or dormancy of the obligations that you don't need, and then they can be reactivated when need arises.
Great, thank you. We also have Joyce who's asking, can a self-employed person contribute to an SSF and at which rate? Kindly clarify tier 1 and tier 2.
So the first bit about being self-employed, the benefit is, remember, you can make top-up contributions. That is one thing which you can take advantage of. And remember, this is more or less your provident fund money, so after retirement, it will still come back to you. So it's less of a deduction and more of someone keeping your money safe for you, as opposed to SHIF, which goes and never comes back. So they can make their contributions voluntarily, just as has been the case with an SSF all along.
Great, and I think also now the clarification on tier 1 and tier 2, especially for those who are self-employed or business owners, from that point of view, maybe you could clarify a bit more.
Yeah, for business owners, they might decide to do voluntary. Those are voluntary deductions because it's a means of savings. So what will happen is that there is a minimum amount for tier 1 that you should contribute. That is 6% of lower earnings limit. The lower earnings limit would change from time to time. Currently, it's at 7,000. So automatically, 6% of 7,000 would go to tier 1. For tier 2, it's where we are saying it's anything over and above earnings in excess of 7,000. That we are saying that you need not make to contribution to NSSF. But now for a self-employed person, this might be a bit of a challenge because it's the employer who would option to contract out, not unless the self-employed is also an employer and is contributing on his behalf as an employer. Then in that case, yes, you can opt out and contribute to maybe a provident fund. But in this case, tier 1 and tier 2 are just categories. Everything will still go to NSSF, but now these are just categories, and tier 1 and tier 2 categories would dictate accessibility of funds at maybe end of retirement, because there's a way you can, for tier 1, you will not be able to access, but for tier 2, you can be able to access at certain points. So everything will still go to NSSF, but now in terms of accessibility, that's where the issue would come in.
Okay, great. I see some participants have raised their hands, so allow me to invite Matthias and then Bob to ask their questions. So, Matthias. All right, as maybe Matthias finds his speaker. Bob, are you able to speak? All right, okay.
Yes, I'm able to speak.
Okay, great. You can go ahead and ask your question.
I want to ask a question on NSSF, especially the tier 2, of maybe opting out of the contribution to the NSSF to maybe a private pension scheme. Is it possible in a scenario where you ought? I've heard the trainer saying an employer can opt out to a registered pension scheme company. So when that situation happens, when an employer opts out, and maybe it happens that one of an employee of this company moves to a different company, what happens to the already contribution that has been done to that particular private scheme? Is it possible that when this particular employee goes to the next company, he can maybe continue remitting with that private scheme, or is it that how would you kindly explain this particular situation?
Yes. Now, what would happen if an employer has opted out to maybe a pension scheme or a provident fund scheme? Then it means that the contributions will not be made to NSSF, that is for tier 2. So in this case, the contributions already made can be transferred. Say this employer goes and joins another employer who is also registered with a different pension scheme. So in this case, the amount already contributed can be moved to the new pension scheme without a problem. But now an application has to be made.
Thank you.
Great. I think we can have Muritu.
Yeah, thanks a lot. Thanks a lot for this informative information. Are you able to hear me?
Yes, loud and clear.
Yeah, my question is about the withholding tax. I imagine I'm supposed to, when I get the money is deducted from this, as I get it from the source to the 5%. And I believe I'm supposed to give now the 25% to the KRA. Now, imagine I reside in Nairobi and I worked in a place like Kitui. And for 2 days, I am given a professional fee of about 50,000. Now, I wanted maybe just briefly a practical example how I can declare my expenses so that I am able to cover the 25%.
So ideally, let me just explain the whole analogy of withholding tax. And as we say, this is tax deducted at the source. And why the Revenue Authority would use such a scheme is so that they are able to collect early, that is one. And number two, they ensure that you do your correct declarations of revenue. So what happens is this, that at the end of the day, when you're paid the 50,000, the person paying you will be obligated to withhold 5% of that amount. And in turn, what you will receive is a withholding tax certificate, which then means a credit on iTax. So when you're filing your annual returns, you will have to declare the withholding tax credits that you do have from amounts withheld, which then means that at the end of the year, assuming your cumulative revenues or your cumulative taxable profit is around 1 million, then the tax on it is 30%, which is 300,000. That does not mean you will have to pay the 300,000. You'll have first to offset the withholding tax credits that you have and pay the balance. So that's how the withholding tax will work. But remember, before you derive the 1 million, which I've assumed is a taxable profit, you basically take your revenues, you less the allowable expenses. These allowable expenses are generally expenses that are incurred in generation of that revenue. So we are looking at the business expenses. And even as we are talking of the business expenses, the other prerequisite will be the issue of e-teams, which we are going to discuss in the next session after the break. So that then we know that that is also a prerequisite in terms of what you should deduct as an allowable expense and the compliance around such expenses.
Great, thank you. Sorry. Yes, Morito.
Yeah, what is not very clear to me, let's imagining maybe I didn't have any other income. I only had that 50,000. Yeah. And the KRI, okay, the withholding tax took the 5%, which is okay. So I'm supposed to pay 25%. Is it true?
So ideally, the tax that will be computed will be 30%. Then once you take, that is on business income, right? Or you're working as an individual, or is it?
Yeah, as a consultant work I have gone to do maybe, for example, in Morango or Kitui or somewhere else.
Okay.
Then I'm paid the money, and then the 5% is deducted. So I'm at the end, I'm supposed sometimes to give to KRI the 25%. If now I want to show them that I use this money, how do I now do I go about explaining the expenses? Because maybe the 50%, the 50,000 or the 40,000, if I try the much I can, say how I used it in Morango or Kitui or somewhere else far away.
Yeah.
I'm not. How legally am I supposed to do it? And yet I don't want to say I paid the school fees with that money, so that I'm not able to pay the 25%.
Yeah. So ideally, that goes back to the allowability of the expenses. Remember, you'll now be filing your own individual return, and which will have a profit and loss that you'll have to have that. And any expenses that you'll be deducting against that income should be expenses that were incurred in generation of that revenue. Case in point, your school fees will not qualify for that because it was not incurred in generation of that revenue. Maybe the cost that might be incurred in generation of that revenue might be the transport for your movement. You said you reside maybe in Nairobi and you went for business in Kitui. But even as we look at that deductibility and we are able to link that expense to that specific income, then now we will also now bring other issues of consideration like the e-teams. In fact, when you are having to deduct any of these expenses for that purpose. But ideally, when you're filing your individual income, that will be subjected to the graduated scale. Then you'll have also to declare your withholding tax credits that you do have coming from any person who had withheld on you. So expenses like school fees will not be deductible in that perspective.
Then I've just seen a further question asking us to explain how withholding taxes work. So there's two kinds of withholding taxes. There's those that are more or less interim, and then there are those that are a final tax. Now, for example, if you put your money in a fixed deposit account and it's earning interest, the interest on that will be subjected to withholding tax by the bank, and it is final. So you don't have any other duty for that if you have a fixed deposit, let's say with DTB. Then there's other kinds of withholding taxes which are not a final tax. For example, like you said, with professional fees, if you offered consultancy services to a company, that company, like assuming a resident, will have to withhold at 5%. Now, the 5% is not a final tax. You will have to go to your income tax return, declare your full income. Let's assume it was 100,000. You'll have to declare the full 100,000, compute the taxes on that. Then whatever is payable, you reduce by the withholding tax already paid. So that if you reduced by all expenses and maybe your tax due was 6,500, you will reduce it maybe by that 5,000 shillings, and then the balance of tax will now be 1,500 shillings. The important thing to also note is, please note that companies and individuals have different tax rates. For company, a local company is simply 30% of all its taxable income. For individuals, you have the privilege of tax bans and reliefs.
Thank you very much.
There's also now a question about, there's some questions which have come up about per diems and allowances, especially travel. Now, the key thing with travel and per diems, first of all, is to ensure that they are incurred strictly for business purposes. So, for example, if we've been sent on a work trip to, let's assume, Voi, to go do some client work, that is, will be reimbursed for that fuel expense. Now, you'd find that you can be reimbursed at standard rates. For example, the AA rates are generally the fairest rates to use. But you see, for that one, you need to maintain supporting documentation. For example, you need to maybe, like what we use, which is very effective, is a Google Map printout, just to show where you started the trip, where you ended the trip. That will show the basis of the distance. Then you can use the AA rate, which is 45 shillings per kilometer. In terms of accommodation, again, there's two ways to do it. The first is the business can directly pay that expense. So they can tell you, please tell that hotel invoice to invoice in the name of the company, which is one of the most effective ways. Then the company can directly pay, or the employee can pay, then get reimbursed for that specific cost. But then again, at all times, you must map it back to something, some sort of business income, not leisure. So, for example, if you're a client there and an assignment there, that would qualify as it.
Then maybe on travel, the other issue to note is, and this is where you have maybe travel for any expatriates that you do have, or any international travels, you need to provide or maintain proper support. Remember, the burden of proof is always on the taxpayer. So in case of a revenue authority audit, you need to have enough evidence to link any of those travels to business. So if you are going for a meeting, you are meeting a client outside, so you need to maintain even minutes of such meetings, and even not just the flights or the tickets. You need also to maintain any correspondence that would act as proof that actually you are going for that. You incur that cost, that travel costs, for business purpose and not for any other purpose.
Great. Thank you so much, team. I think we can proceed for the break. And just to share with the participants that you can continue addressing your questions in the Q&A tab. And we have James, Josephat, and Zioka who are answering some of the questions on the tab. And as we've noticed, the engagement in terms of questions is quite high. So after the presentation that will be done, we will still allocate more time for questions. So team, unless there's anything more to add, we can proceed for the break. Josephat?
Yes, I think we can proceed for the break, and maybe an indication of what time we resume the second session.
Yeah, we can do 15 minutes. So 10:25, we can proceed with part 2.
Okay, fair enough.
Great. Thank you, everybody. We are on a 15-minute break. Continue with the tax session. And this is part 2. As per usual, you can share your questions on the Q&A tab, and we will get to them at the end. And then allow me to disable the chat tab, and we'll enable towards the end as well. So Welcome, team. I can see Nzioka. Welcome for the second session. Thank you.
Thank you, Mantui. Good morning, everybody. My name is Nzioka, and I will walk you through the part of the presentation on ETIMS. Now, ETIMS is more or less the electronic tax invoice system, and it's been a development over time. It was initially the TIMS, which is now an upgraded version, which is ETIMS with more features. Now, it came into the requirement to use ETIMS came into effect on 1st September 2023, which enables KRA to more or less establish an electronic system for you to run your transactions through. It was rolled out much earlier in Feb 2023, but right now it is mandatory. Now, the KRA also noted that there was need for some sort of transition period. That's why it gave people up to about 1st of March 2023 to ensure the onboard. Now, if you had not, the first March 2023 deadline was not per se an exemption period. It was simply a period for you to migrate all your manual ETIMS invoices for 2024 onto ETIMS system. Now, another key thing about ETIMS is it is not specifically for VAT sales only, but for all supplies by way of business. So whether or not you're registered for VAT, you will need to set up an ETIMS as long as it's a business activity you're carrying out. Now, if you already have a TIMS machine, you need not migrate to ETIMS unless you're notified later by KRA. So for now, you're good to go, more or less. You may voluntarily change your system, though. Now, ETIMS has several solutions depending on the size and needs of your business. The first one is there's a USSD system, which is very simplified. Second is there's a mobile app. Third is this Windows app. And fourth, which is for people with many branches, you'd find that there is a system-to-system integration. So more or less, this can integrate with your ERP and directly transmit transactions to KRA. This is useful, especially where you have multiple sales points or multiple branches. Now, another key function of ETIMS with regard, apart from just supplying of transaction information, is maintenance of stock records. So you'll generally be required to maintain your stock records if you're in the supply of goods on ETIMS system. Then if you're trying to upgrade to ETIMS, please ensure that you use an accredited system integrator. If you're doing the system-to-system integration, these are people who've already been trained by KRA, and it's to reduce the risk of anything going wrong with your transition. Now, the first thing is, remember, all your sales must go through ETIMS, and second is you can only claim expenses if they are ETIMS compliant, but there are certain exemptions with regard to such. The first one is emoluments. This is more or less salary payments and all such payments to employees. Then there's imports, both of goods and services. There's investment allowances, interest, airline passenger ticketing, and similar payments. Now, KRA can, by Gazette notice, extend this list of exemptions to cover more. As stated before, remember, all taxpayers, including those who are not registered for VAT, need to comply with ETIMS. Now, if your expense is not among the exempted items, and you will not be able to claim that as an allowable deduction when computing your income tax expenses. So it's important to actually map out within your business what are the various expenses you have and are your vendors ETIMS compliant. If they're not ETIMS compliant, it's very important to actually pre-calculate your risk to more or less say maybe your exposure per month is maybe 10,000 shillings in expenses or something of the sort. Another key feature with ETIMS, which we've noted, is the auto-population of returns effective January 2024. Especially those of you who've been registered for VAT, I'm sure you have noted that your VAT return would auto-populate, especially the sales. The sales would, now there's two key things to note with regard to the auto-population. The first is the sales. It will automatically pick the sales that you put on the system. And for purchases, it should automatically pick all the purchases which had your PIN on them and which were ETIMS compliant. From a sales perspective, now actually another thing to mention is at the beginning of the implementation of ETIMS, there were a few system glitches which I believe have now been cleared out, and they are seeking to improve their systems every day as KRA. Now, in an auto-populated mechanism, you cannot claim any input VAT that was not in the system. and you cannot adjust your, you more or less cannot adjust your expenses up, and you cannot adjust your sales down. So if your sales as per your ETIM system are, let's assume, 2 million shillings, you cannot make any adjustment to reduce them to 1.9. The only proper way to do so would be to use a credit note and to run that credit note through the ETIM system. Now, there's certain frequently asked questions which we've noted. The first is with regard to whether or not there's an exemption for people who are supplying, whose supply values more or less are below 5 million shillings. Currently, there is no exemption for such. So even if, no matter how low your turnover is, you need to comply with ETIMs as long as you're conducting a supply by way of business. It was the 5 million threshold was one of the main concerns raised, but it was never documented in terms of legislation or regulations. So even no matter how small your vendor is, no matter how small the expense, please ensure it is ETIMs compliant. There was also the onboarding deadline for ETIMs, which was put at 31st March 2024. People's main query was for supplies incurred or procured between January and March of this year, were they allowable for tax purposes? They are allowable for tax purposes under two conditions. The first is they need to be a business-related expense. Second is the supplier had until March to ensure that they onboarded, that they more or less digitized this by putting the expense on ETIMs to enable you claim it. For companies that have a non-December year ends, we are still awaiting guidance from KRA on how to handle such situations. Now, another concern is most government entities, including county governments, are yet to issue ETIMs compliant invoices. The main question is, will these be allowable? It's a matter that has been raised with KRA as well as the government entities, and they're working on resolving the same. But as it stands, there is no explicit exemption from ETIMs for the same, but we are still awaiting communication from KRA on the same. Now, the next one is how disbursements are treated, especially whether disbursement is a recovery. For example, if you've probably invoiced a client 50,000 shillings for services, and maybe there's 2,000 shillings of disbursements, which you directly incurred on their behalf. Now, ETIMs has a provision to capture disbursements as non-principal data, and therefore it will not be part of the data that is transmitted to the ETIM system in terms of numbers. But so ETIMs does require configuration to capture this, but it's one of those things which they are working on. The next question is with regard to exempt bodies. So there's export processing zones, special economic zones, and not-for-profits. Not-for-profits cover various variety, for example, CBOs, NGOs, all those sort of organizations. Whether or not they're required to onboard on ETIMs. Yes, they are required to onboard on ETIMs. They are not exempted. The key thing, especially with not-for-profit organizations, is to ask yourself a simple question. Is this income incurred by way of business? So, for example, donations are not a form of business. Thus, for the not-for-profit, they need not declare their donations. However, if the not-for-profit has, or even the EPZ has any rental income or any business income, they might have consultancy services. All of those will need to be run through ETIMs. Will subscription to professional services bodies be allowable for tax purposes? Again, now, for example, we at RSM, that's one of the major concerns we also had. But KRA will issue guidance after consultations. But most professional bodies are also trying to comply because they are also affected. So it's a matter of giving them time and following up with them. Will airtime given to staff be allowable for tax purposes? Airtime and all sort of mobile purchases should be supported by an ETIMs compliant receipt. We understand for certain mobile service providers, it is easy to obtain the same. So there's various options. You might purchase in the company PIN, then what you call sambaza it to your various employees. So that one is also to work. But there's also been implementation proposals which have been shared with KRA on how to make it happen, because many of us buy airtime through various means. Now, another one which is a thorn in the flesh of many businesses in Kenya is questions like matatu fares, expenses incurred in terms of matatu fares, purchases from small-scale farmers and other small vendors. How will they be addressed? given that most of these vendors are not ETIMS compliant and they are necessary for the running of our business and day-to-day lives. Currently, there is no exemption on such expenses, so they would all need to be ETIMS compliant. But KRA is coming up with various simplified mechanisms to sort these out on the basis of stakeholder engagement. For example, there's the USSD basis and all that. Yeah. So it's important to also talk to your vendors and try and encourage them to comply. If not, then you need to try and calculate how much of your expenses would be disallowed. KPLC invoices are not ETIMS compliant. How will buyer details be captured by KPLC? So one should go back to KPLC and get an ETIMS compliant invoice. KRA is working with KPLC on this. Another thing is also, it's important for KPLC invoices, please ensure that the invoice is in your name or in the name of the business which is supposed to claim the expense. Because we've noted with quite a number of KPLC clients, you might find that people never bother to change the customer name, even when they've switched premises or there's a change in business ownership. Will donations to charitable organizations be allowable for tax purposes, as they will not be ETIMS compliant? So donations are not a supply by way of business, therefore would not be required to be under ETIMS. Second is donations are allowable as a tax deductible expense under Section 15 of the Income Tax Act. So if you've made an exemption, if you've made a donation, you can always claim that as an expense. But it's important if you're making a donation to check several things. One is, are you donating to an entity that has an income tax exemption certificate? Because if they do not have an income tax exemption certificate, you will not be entitled to claim that expense. Second is, it's also important just to ensure proof of donation. So if it's a monetary donation, of course, the bank transfer would suffice. If it is donation in kind, you need some documentation like delivery notes and such things just to ensure that the same is allowable. Third is, please ensure that donations are only claimable if they are irrevocable. You should more or less, so if you want it to be a deductible expense, there should be no provision for you to recall your donation if you are unhappy for one reason or the other. The next one is on bad debts, because we all incur these in our various lines of business, is how will these be affected by ETIMS? So bad debts will be allowable under Section 15 and Legal Notice 37 of 2011. With regard to bad debts, please ensure that you meet the threshold for the allowability of the bad debts. Legal Notice 37 provides 6 criteria. You just need to meet any one of them and demonstrate proof that you've met the criteria for you to claim the bad debt. For example, if you need to show that the cost of recovery of the debt is higher than the debt itself, quotations from service providers like auctioneers would suffice. For example, if ABC owes you 30,000 shillings and the auctioneer gives you a quote for 50,000 shillings, that would demonstrate that it would be throwing good money after bad. Then for those of you who deal in business, in goods, you're questioning as to whether or not the stock write-offs, whether or not these will be allowable and whether or not the stock management module will recognize the stock write-offs. So for those of you who are using ETIMS, that will be done, that's possible. But for those of you who are using TIMS, the TIMS device, there is no provision for stock adjustment. So you need to do that in your accounting system, as well as maintain documentation for the reason for adjustment of your stock records. It may be that maybe goods went bad or something of the sort, or maybe goods were returned back to the vendor. Now, for those of you who have transfer pricing concerns, there is a query of, for those of you who use the transaction net margin method to reflect a markup on related party billings, how will the markup be reflected? So the current status is that the markup should be raised in the correct period using available information, and any adjustments to be made in subsequent period, but make sure that the invoice is raised in the correct tax period. Now, the last one is with regard to foreign exchange losses. Will they be allowable for tax purposes? The thing is about forex losses is they're not dependent on one transaction. It's usually a series of ins and outs. You purchased maybe dollars at this rate and sold them at this rate. So the combination of those two transactions is what will now create the loss or gain. Now, Section 23, which of the Tax Procedures Act, which provides the exemptions from items, talks about similar payments to financial charges or modest interest. So this may fall under there. But once the legislation is put into place, the regulations, rather than they provide clarity, because they do provide for financial services. Let me now we'll hand over to my colleague Josephat Karanja, who will address key tax issues that most SMEs tend to be non-compliant on.
Thank you, Nzioka. I don't know whether you can still see my screen. Would you mind if you can confirm?
Yes, we can. Thank you, Josephat.
Okay. Yeah, so I think in this session, we'll be looking at the key issues that we are seeing, and especially when we are handling revenue authority audits. So these are mostly the issues we are seeing recurring to most taxpayers. And I think the importance of highlighting this is so that you can know on a compliance perspective, then what areas should you be looking at, and maybe what are you supposed to be keeping as record in terms of for preparation of any audit that might happen. The Revenue Authority audit is one of the issues that we are seeing very prevalent in the recent past, and I think it will be the same even going forward. Remember, the tax laws in Kenya allow the Revenue Authority to go as back as 5 years to review your records, and they do this under the Section 59 of the Tax Procedures Act. And basically, they are reviewing your records to ascertain your levels of compliance. And mostly the outcome of the exercise is that if you are found to be non-compliant, then they will be looking to issue with an assessment. And for that assessment, then you will see issues to do with penalties and interest also kicking in, which is what we had mentioned as the additional cost of non-compliance. So it is important that you keep your compliance levels as up as possible. So we will do this based on the tax obligations. Most companies will have a corporate income tax obligation, and especially those in the manufacturing sector. One of the reconciliations that need to be maintained, and we've seen the Revenue Authority always coming and testing these, is the production reconciliation. So the importance of this is that you are able to have a reconciliation looking at the movement in your stock, and the stock at this level might be at 3 levels. You're looking at the raw materials, work in progress, and the finished product. Remember, any variances in this production recon, the Revenue Authority will always treat that as sales. So if you're unable to reconcile all your raw materials, any variances, the Revenue Authority might be deeming them to be sales and want to charge a corporate income tax on that variance. So it is important that you keep proper records in terms of your stock records and maintain a production reconciliation at least every year in readiness of such. The other item we are saying, and remember, all this reconciliation will touch both the corporate income tax and VAT. Anything that will be deemed to be a sale for corporate tax purposes will also be deemed to be a sale for VAT purpose. So if whatever you're dealing with is they are vertible, then you might imagine then it will be a double-edged sword that will cut both VAT and corporate income tax. The other test that we are seeing coming up is the banking reconciliation. And what the Revenue Authority is doing is trying to match the amount of monies that are coming within your bank, within your bank account, and the sales that you're declaring. So you need to actually maintain a reconciliation between your sales and your bankings. Remember, if you have more bankings than the sales you declared in the return or in your financial statements, then the Revenue Authority will be taking a presumption that you have actually under-declared your sales. So most importantly is to maintain this reconciliation. Remember, they do agree that there are some amounts that will come into the bank, into your bank account that are not necessarily sales. For example, some businesses will get funding through a loan. That loan will be a credit in your bank statement. It is not a sale. So you need to keep, to maintain that and know that that would be one of the reconciling items. Other reconciling items will be maybe bounce checks, which will come in as a credit. You'll see some intercompany, some interbank transfers, especially for businesses that are maintaining more than one bank account. So you might see a transfer from one bank account to the other. That also kicks in as a credit in one of the bank accounts. So you need to distinguish such transactions to just make sure that your bankings can reconcile with the sales that you have actually declared in any specific year of income. The other issues that we see KRA touching is mostly on the treatment of intercompany transaction, and I'm now talking about related party transactions. And especially if it is a cross-border transaction, then the issue of transfer pricing comes in, and any taxpayer is required to maintain a transfer pricing policy to support those transactions. Just to bring this into perspective, and when we are talking about related party transactions, and these are those that are cross-border transactions, revenue authorities within the world always want to get their fair share of revenue, in terms of they want the fair share of revenue declared there for tax purposes, so that then you can pay your rightful tax in that jurisdiction. But because of instances of profit shifting and base erosion, and just to bring that in perspective, is where two companies are transacting, two related companies are transacting. One is based in Kenya and one is based in a fairer tax jurisdiction. We might talk of whatever we call the tax havens and that, with the maybe fairer tax rates. Most of them would want to shift revenues from the Kenyan entity, the Kenyan company, so that that revenue is recorded in the other jurisdiction. So if you are transacting and if the company is buying from the company, from the entity that is outside, you might find that the company outside is actually overpricing the product, so that then more revenue is shifted to the other jurisdiction, which has a fairer tax rate. So to avoid that, then the issue of transfer pricing kicks in, where you need a transfer pricing policy, which has been documented and basically will be guiding all intercompany transactions, all related intercompany transactions. And in terms of, and we'll be concentrating on what is the actual pricing of those intercompany transactions. And there will be transfer pricing methods that basically are looked at when coming up with a transfer pricing policy. These mostly will be concentrating to actually show that the transaction is at arm's length. And arm's length, I mean, and for example, one of the methods, one of the transfer pricing methods is the CAP method, which is a direct comparative method. So you're looking at if you were to transact, if the same transaction was to happen between two unrelated entities, what would be the pricing? Then comparing that with the pricing that you actually adduced to this related party transaction. So this is one of the documents, one of the preliminary documents that will be required, especially if you have intercompany transactions on a cross-border perspective. Foreign travel costs, I think this is one of the issues we had mentioned when we had the initial Q&A, in terms of the documents you're supposed to keep for any foreign travel costs. you have to link that such cost with business and with generation of that revenue. So you'd have to maintain minutes. Maybe if you are meeting, you're going to meet a client, you have to maintain minutes for those meetings, the agendas, and the air tickets showing that you are actually traveling, and any correspondence showing that you are actually traveling for meetings that are business related. There is also another issue which we are calling grossing up of withholding taxes. And to bring this to perspective, there are some contracts that you will agree with your suppliers that you've agreed net of taxes. So the contract does not, maybe is worded in a way that the amount for that contract is a certain amount, exclusive of taxes, which then means if it was a consultancy service, and you know those consultancy services falls within the purview of withholding taxes as management services, then ideally you would have then to gross up such amounts for withholding taxes, remit the withholding tax, and remit the net amount to your supplier. In such case, remember, because you agreed the contract net of taxes, your supplier only invoiced you on the net amount. So you do not have any support for this withholding tax, which then means it is a disallowable expense. That is what we are seeing most of the taxpayers missing out on that. Remember, withholding taxes, while the obligation is on the person making the payment, that is the obligation to remit. The tax burden is always on the recipient of the payment. Case in point, if you agree a contract inclusive of all taxes, assuming it's 100 shillings, and it is a professional service, then you'd have to remit 95% to the supplier and 5% to the revenue authority. But on to the contrary is that if you agree a contract not inclusive of taxes and such has not been invoiced, then it means you will be paying the full 100 to the the supplier and an extra 5%, which is the gross up withholding tax, to KRA. So that extra withholding tax is not a business cost because it was ideally a burden, should have been a burden on the recipient of the payment. Pension contributions. So we know that pensions are allowable up to a limit of 20,000 per month. That is the limit that we do have for allowable pension. So any excess pension, any excess contribution over and above the 20,000 is disallowable. And how to look at excess pension is you have to first deplete the amount contributed by the employee before now you can look at the amount that is to be contributed by the employer. Most employers match the contribution of the employee. Case in point, if I would give an example, is assuming the employee is contributing 15,000 and the employer is matching such that payment, so an extra 15,000. So the allowable portion is still the limit of 20,000, which means you first deplete the first 15,000 contributed by the employee, then you go back to looking at how much is allowable on the employer. So in that scenario, then that would mean that the 15,000 contributed by the employee is fully allowable. Then 5,000 of the employer's contribution is allowable, which then means that the excess 10 will be a disallowed expense disallowable expense on the employer. And in case the business or the employer is exempt from tax, then that portion is always taxed as a benefit on the employee. So those are some of the items to note on that perspective. On withholding tax, mostly will be on installation fees, and especially people who engage in very capital intensive projects where you agree on a contract for supply and installation. So when you agree on such a contract, the portion that relates to installation needs to be subjected to withholding tax. So we see most of them aggregating the whole contract and not subjecting anything to withholding tax, citing the contract also had delivery of goods. But remember, the portion that relates to installation should actually be subject to withholding tax. The other one is on licenses and right of use. We see some businesses paying for subscriptions. Remember, these subscriptions or licenses fall within the definition of the right to use. Remember, you are paying this license so that then you can access. If you're paying a license to access a software and its functions, that is actually a right of use, which then qualifies as a royalty, which is also subject to withholding tax. So for those periodic subscriptions of licenses, you need to be cautious or ensure that such are subject to withholding tax as royalties. On pay-as-you-earn, most businesses contract some labor as contractors and not employees. So there is a thin line between who is a consultant and who is an employee. And the Revenue Authority will always do what we call a MICE test. And a MICE test, the abbreviation is the Mutuality of Obligation, Integration, Control, Economic / Business Reality. That is the MICE test. And ideally, they will be looking at one, how is the contract worded? Remember, the contract you have will be worded in certain with certain benefits. For example, an employee will be entitled to have leave. A consultant is not expected to have leave because they are expected to work as consultants. So if the Revenue Authority is reviewing some of those contracts and see some benefits that are actually benefits of an employee, they might deem that consultant to be an employee. And the tax exposure, should that happen, then means, whilst you had paid withholding tax at maybe 5% on that consultant, the Revenue Authority will compute pay-as-you-earn and look at what is the difference between the withholding tax that you paid and the pay-as-you-earn that has been computed, and the difference becomes an exposure to the business. So it is important to check. And looking at that, you're also looking at the degree of control. Do you are you providing that these consultants should be at your premises from 8 to 5? Ideally, that should not be the case for a consultant. Are you giving maybe medical benefits to that consultant? Mostly, you don't give medical benefits to a consultant. They're only given to employees. So such are the things that you need to look at when you're looking at the difference between who is a consultant and who is an employee. Or else, in case of an audit, you might find yourself exposed. The other one is the issue of bonus versus dividend. And you will attest that most SMEs who are maybe running as companies will have directors who are also shareholders. So they are also employees of that organization. And at maybe the end of the year, such businesses might decide to declare a bonus to all employees, including the directors who currently are employees of maybe such a company. However, looking that those directors might still be the shareholders, there is a thin line between what is the payment, what is that payment made to that person? Is it made to him as a director, or is it made to him or her as a shareholder? And our Tax Act defines a dividend as any distribution, any payment made to a shareholder in respect of their shareholding. So you might distribute a bonus, but then, and you've paid PAYE on the bonus, then a few years later, the Revenue Authority comes to audit you and tells you, actually, yeah, it is okay, you paid PAYE, but this is also a dividend because of the definition of a dividend. It says anything, whether it is cash or property, that is distributed to that shareholder. So in that case, and the thin line here is, it will only be deemed to be a dividend if your distribution of these bonuses to these directors are based on their shareholding ratios. So then there is that risk. So of most importance is to make sure that if it is a bonus, let it be based on a KPI and not on the shareholding ratios. Because if you distribute this on a shareholding ratio, it might be deemed to be also a dividend, and carry will come for an extra 5% as withholding tax on the dividend. On pay as you earn, there is also a reconciliation that you need to make sure that you maintain. Mostly remember, staff costs are business costs, and they are allowable for tax purposes. However, now KRA will be coming and conducting a test to actually verify your staff costs that you are allowed for tax purposes by maybe carrying out a reconciliation between what are your staff costs as per your corporate income tax return, and actually what did you declare for PAYE purposes. So you need to reconcile that and maintain that reconciliation, because any variances might be disallowed for corporate tax purposes. That is, if whatever you declared in your payroll or in your PAYE returns is more than is less than what you actually declared in your corporate tax return. So they might be looking at such variances and looking to disallow them, charging an extra 30% and penalties and interest thereon. So those are some of the issues to be keen and what you need to maintain. On a VAT perspective, just like the corporate tax perspective, you need to maintain a reconciliation between what is your revenues declared as per your corporate income tax return and your revenues declared as per your VAT returns. The Revenue Authority does not expect any discrepancies between these two, because these are all your revenues that you've declared. So any shortfall is always deemed, and this is also a double-edged sword. If the sales declared as per the VAT return are lower than the sales declared as per your income tax return, KRA will deem it as an under-declaration of sales for VAT purpose. And the vice versa is also true in terms of they will hold if your VAT returns indicate more revenue than your corporate tax return, then they will deem it an under-declaration for corporate tax purposes and charge a 30% on it. Purchases reconciliation is another. Remember, purchases forms part of your stock reconciliation, and this is what comes in as an allowable expense. So you need also to reconcile this. We are also seeing them even going to the extent of reconciling your purchases against import data, especially if you're importing most of your products. Apportionment of input VAT, this is another topic, and this mostly covers taxpayers who deal with mixed supplies. And when we say mixed supplies, we are saying those who deal with both vatable and exempt supplies. Remember, as we had mentioned in the beginning, you only required or you only allowed to claim input VAT relating to supply of vatable supplies. So if you're dealing with both vatable and exempt, the portion that relates to the exempt supplies is not deductible as an input VAT. So you're supposed to look at your total overheads, and especially these are the ones that you cannot specifically attribute to generation of either the vatable or taxable. So the first preference is always given to a direct attribution, such that all input VAT incurred in generation of vatable supplies is fully deductible, and no deduction is allowed on any input VAT in generation of that portion of exempt supplies. But where you have overheads that you cannot directly attribute, case in point, you have rent or electricity bill, which ideally it's for the business, and the business is involved in supply of both taxable and exempt, you need to apportion the VAT to the proportion of whatever is vatable and what is not vatable. So you only claim the proportion of what is vatable. So that is one of other aspects that we are seeing most taxpayers missing out on, which are leading to KRA assessments and penalties and interest thereon on a VAT perspective. So I think, ladies and gentlemen, that in a nutshell are the issues that we are finding on that perspective on most of the audits and what most taxpayers are missing out on. And I think now we can go to the next session, which is mostly a Q&A on the areas covered. Maybe Manti, you can take it up from there.
Okay, great. Thank you. Thank you so much, Josephat and Zioka. I will also just open up the chats for any feedback that we may have as we address the questions. So at this point, I'll begin with those who've raised their hands, and then we will come back to the Q&A tab. Please note that a lot of the questions have been answered, so you can also just review the tab for the other questions. So at this point, I'll invite Edwin. Edwin, you can go ahead. And after Edwin, we'll have Michael. So just be on standby. Karibu, Edwin.
Thank you very much. Highly appreciate for the session that we're having today. Quite insightful. And I think it could really help me with my day-to-day job. So I've been conversing with the RSM team on chat. So maybe I'll just like to reiterate the question in this specific case, and this is around withholding tax and how, as you decide to subcontract somebody to come and do a job, and the individual is, the subcontractor is an individual, how do you have the company come in and use that invoice, use that expense as a deductible expense while doing their taxes towards KRA? So I don't know what somebody can be able, somebody from RSM can respond, and maybe they can just give me an overview.
Is both individuals, companies, partnerships, any form of end person can register for ETIMS. So even that individual can register for ETIMS, and they can issue your company with an ETIMS compliant invoice. You will then withhold on that invoice. I hope that answers your question.
Yes, that answers the question. So in the eventuality they do not register for ETIMS, what would happen thereafter, especially when it comes to company X and they would want to use that as a deductible expense? What would happen thereafter?
So there's two ways of handling it. The first is you can actually, what I'm encouraging people to do is just go through your list of vendors to ensure that they're all ETIMS compliant, because again, it affects your bottom line. You have two options. One is get them to comply, or two is just take a hit. Or the third option is just to have them directly invoice your customer, but then you see that the problem will not be solved. It will simply be transferred to your customer.
Mm-hmm.
But we've seen quite a good uptake with regard to people dealing with companies, because most of them understand that they might be struck off the list of approved vendors if they're not ETIMS compliant.
Okay. And if I was to put this scenario forth, and by that I mean, if you would know the exact amount that you need to pay subcontractor Y, and you've already accounted for the relevant taxes, so the 30% that they would need to pay to KRA, depending on the invoice that they would have raised but did not raise, but you already know you need to pay them, the amount. Would you pay that 30% directly to KRA, even though KRA is not cognizant of the fact that they've received an amount?
I beg your pardon, please repeat.
Yes, I'm saying, let me just use specific figures. So in this specific case, you pay the subcontractor 100,000, and you already know out of that 100,000, they need to pay 30% as tax. So they didn't give you an invoice. So, but you already know that you need to pay 30% in taxes, which will be around 30,000 to KRA. Can you pay that 30,000 to KRA directly as the company, even though KRA do not know that the subcontractor Y got 100,000?
Now, it was not advisable, apart from the case of withholding tax, it's not advisable to pay taxes on behalf of another, because you see that might distort your return. For example, if you increase 30% on that 100,000 shillings, so what will happen is your returns will go up by that amount, and it might cause a mismatch between maybe your income taxes and your VAT, which would be a very difficult issue to explain. Second is you would have no basis in law to deduct more than the withholding tax amount from their payment. So the main thing is just to have a conversation with the vendor and tell them, are you able to comply with ETIMS or not? At that point, you would need to make a decision on whether or not you will move forward with them.
Okay.
Yeah.
Okay. Thank you. Thank you. That answers my question. Thank you very much.
Then we had a question concerning bad debts. Bad debts must be looked at from two perspectives. The first is an income tax perspective, and the second is the VAT perspective. Now, the regulations that we're talking about, the legal notice 37 of 2011 relates to bad debts for income tax purposes. Now, for that one, you simply need to demonstrate any one of the 6 criteria. And you would need to have evidence that the same has happened. For example, if you need to show that, as I said, if you need to show that the cost of recovering exceeds the debt itself, you would need to quantify the debt. Let's assume you need documentation to show maybe you supplied goods worth 100,000 and they've not paid and you've had the correspondence. Second is you need to show maybe the costs of an auctioneer or a debt recovery expert by getting quotations from them. That would be evidence that the cost of recovery exceeds. Now, from a VAT perspective, the threshold is different. First of all, there's a time limit. You would have to wait for 3 years for you to apply for VAT refund on bad debts. Second is, for VAT, the person who you supplied to would need to be in some form of statutory management, administration, receivership, or liquidation. In such a case, you would have to make the application before the lapse of 10 years for you to lodge that application. But the key thing is maintaining documentation to even show, like, for example, if you claim they're in receivership or something of the sort, a gazette notice or any public notice to that effect would suffice. We need to maintain such a copy in case of a KRA audit. And we also recommend that you maintain these documentations as the transactions happen, as opposed to waiting for KRA's audit. Because when you get a KRA audit, it tends to be very difficult to comply with a request for information when you don't have documentation. Another question which I can see from Caroline on the chat is, how do taxpayers with so many discrepancies seek assistance?
So mostly, and especially when you get some of this, I know it is when you're able to maintain consistent reconciliation, then you find yourself having to solve these discrepancies early enough. But mostly in where a tax consultant comes in is in case of a revenue authority audit to assist with some of these reconciliations, because we need to look at the transaction and actually what happened. Yes. Sometimes we need to do a detailed check on assuming, and maybe in this case, I can use an example of a banking deposit. We need to interrogate every credit to ascertain what that was and see if that could be used as a reconciling item. But however, where there is a clear under declaration, then the revenue authority will always be seeking to charge that tax. Maybe mostly, and what we've seen in the recent past is that when taxpayers realize that they do have some of those discrepancies which might have led to another declaration. We had initially the voluntary tax disclosure program where most taxpayers went in and did a self-declaration, or the just ended tax amnesty where taxpayers got a remission of penalties and interest. Yeah, we know there is a proposal to bring back the amnesty. Maybe it might come. So I think if it comes, then anyone with such problems might take that advantage and try and clear such discrepancies within the amnesty period. Because after that, we are not sure of any amnesties that might come in the future. So maybe Mantu, you can go to the next person.
Yeah, I think we can have Michael and then we go back to the Q&A tab. So Michael Mukuchia.
Morning all, hope you're all well. Yeah, just to point out, I had already raised a concern regardless to expenses given for mobility and mileage. I think you had already clarified on the same in terms of the processes. Now my second question goes to the disputed VAT. This happens in scenarios whereby you just sell goods to clients, then eventually the client remits as VAT added goods. Then after some time, you get a letter from KRA telling you that these supplies you've made to customer X and Y, you've never remitted anything. So it becomes a tussle with the taxman. So in most cases, we've been getting that, and yet at that point, we are not registered for VAT. So how does one go about it? That's one of my concerns. My second point lies on the directors being the staff at the moment, since the business is a startup. they are the ones getting the benefits. How is it accounted for to differentiate the beneficiary owner, who happens to be their shareholders, who happens to be the staff, from getting the entitlements for working, since the business is still a startup?
Sorry about that. We were having internet challenges.
Yeah. Should I come again?
Yes, please. I think we had an internet connection issue. Maybe Michael, you can go again in terms of your question.
Okay, question one was all about the basic expenses, allowances and expenses. This touched on mobility allowance and per diems. You made it very clear. That one was well done. Now we move to the disputed tax on VAT. Scenarios whereby you've been supplying clients and you are not VAT registered. Then eventually the taxman moves you from not being VAT to VAT, since somebody has been submitting whatever you've been selling to them and submitting they've been paying VAT, where yet you had not registered for VAT 1. You never issued any ETR on the same at that point, and it becomes a dispute with the regulator. Now he's insisting that you have to pay that. The third question is on the directors being the beneficiary owner, the shareholders, and then them being still staff for the business since it's a startup. So they're getting the benefits. How do you differentiate from them to get this as staff, this as shareholders, and these are the people running the business? So it's becoming an issue in basically accountability on the same and trying to explain the point. So I would like clarification on the three, please.
Okay.
Yeah.
Maybe I can go on the VAT issue. First, you've indicated that you did not charge any VAT because you're not registered, right?
Yes.
So the question is always that, and this is why we talk about keeping your records, because you need to demonstrate to the Revenue Authority that you actually not registered for VAT by virtue of not meeting the threshold for registration. That is the 5 million turnover of vatable supplies within any specific 12 months. So once you are able to show that, then you need to show that you did not invoice inclusive of VAT. You did not have any VAT charge on such supplies, which then renders the claim, any person who claimed VAT on your invoice, then that renders them that input VAT claim erroneous, which then means it would be an assessment on the claimant and not yourself. So I think that is a burden of proof that you would need to show the Revenue Authority. And these are some of the issues that the e-teams regime is coming to solve, such that there will be an auto-population. If you charge VAT, then automatically it kicks in as a sale on your side, on a VAT perspective, and forms part of an input VAT on the other side, because you'll be required to also indicate the PIN of the person of your customer. You're making the sales through e-teams. So that will be sorted by the e-teams regime. However, if the KRA after you are around that, you need to indicate or to prove to them that you did not charge any VAT. And actually, you are not supposed to charge VAT if you are not registered for VAT by virtue of not meeting the threshold. I hope that answers the question.
That's clear. That's very clear. Thank you. Now, the second one on the directors being the beneficiary owners, the shareholders, as well as the staff for the business.
Yeah, so we were saying that you need to distinguish between these payments, and the only distinction is one between if you're paying them as the staff, as employees, you do have whatever you have as maybe your employee contract with the business, which will indicate what is your basic pay and what allowances you are entitled. So that goes to PAYE. But any distribution that you'll do based on the shareholding, remember, if you are two of you owning a business 50-50, any distribution that you'll do on a 50-50% based on the reasoning behind, and the reasoning behind it is that you both hold 50-50, then that will be deemed to be a dividend. So if it is a bonus, you need to have clear KPIs that now will determine how much you're paying to each and every of these directors. You need to show that key performance indicator, and have something else. Come up with any other basis of sharing that bonus, which is not the shareholding ratios, because once you use the shareholding ratios, then it defaults within the definition of what a dividend is.
Thank you very much. Thank you very much. That's very clear. Thank you very much. I appreciate it. Okay.
Right. Thank you, Michael. I think we can answer a few of the questions on the chat, and then I just request for those raising your hands, once you're selected, let's try and really summarize and just have one question so that we can answer the most number of questions we can in the short amount of time that we have. So I'll read a question from one of the questions in the Q&A tab, and this is by Samuel Nguru. If you paid AHL on employment income, it is not required on rental income. There was a public notice shared by Kerry on the same. Please clarify further.
So ideally under AHL, if you paid under your employment income, then you don't need to pay AHL again on your gross income. It only kicks in on your gross income if you've not remitted the same under your employment income.
Okay, great. I'll allow Ronald. I think he raised his hand from the previous session. So Ronald, you can go ahead. Okay, it seems Ronald might be having an issue with the audio. So we can have another question from the tab, and this is, how would I go about, from an anonymous attendee, how would I go about meeting my tax obligations for a small retail pharmacy, not registered for VAT, operating as a sole proprietorship or partnership?
So on that one, the first thing I think is to ensure you have systems in place, stock record management systems, purchase records, sales records, and all that. Because if you don't have that, then even neither an accountant nor a tax consultant can help you out. So just shop around maybe for a good ERP system. Then also it's important to just do monthly reconciliations, just to ensure that maybe your stock records are proper and that your sales records tally to your stock records. Because again, if your stock records have gone down by 30 units, it's expected that your sales should have gone up by 30 units. But maybe there was goods you had to write off that were expired, or maybe that the 30 were returned back to the supplier. So the key thing is documentation and systems in place.
Okay, great. Thank you. Thank you, Nzioka. So we have Ronald. I think you've been able to sort out your audio. You can go ahead.
Okay, I'm Leonard. My question was about inquiring on income tax. Having a company that is, others have been performing well, soon the company goes down. Do you have to register, or what happens afterward? On my second question is about the NSSF. You have worked in a company for about 7 years. After that, the company corrupts. What happens to the contribution that you have made? Or you have to wait for your term of retirement? Or what happens next? The third question comes on...
Ronald, allow us to just take the two because of time. Thank you.
Okay, thank you.
Okay, yeah, maybe I can take the first one. You're saying that you had a company which was doing well, but now at some point it starts going down and eventually maybe closes down. So in that case, it will now be upon individual or the owner's call, because from a tax perspective, if the company is not doing any operations, then you have no income and taxes for that matter to declare. So in this case, if it was, you are paying income tax maybe significant amounts, then all of a sudden the company goes down, then it will only be required to file nil returns of income tax purposes. If you had employees and you had registered for pay as one obligation, then you'll still need to file nil PAYE returns. And the same case would happen to VAT. But now, again, you also have the option of registering those obligations, including PIN cancellation. But now for PIN cancellation to be effected, you have to start from the registration, the register of company. So the company has to be wound up, registered and gazetted in the Kenya Gazette for now to initiate the second process of PIN cancellation from KRA side, because KRA will need to know whether the company has already been struck off from the registrar of companies side. So it's a process. But if that is not done, then you will still continue filing nil returns and maybe carrying forward any credits, because in some instances you'll find that when the company was going down, maybe some losses were made, so you'll still carry forward those losses. But again, if the company doesn't wake up, then these losses will be gone. The same case with VAT. If there were credits carried forward, you can either seek a refund for VAT credits if you are dealing with zero rated. If not, then that might also be lost. The other question about NSSF, then those contributions you'll have to wait till retirement age for you to be able to access the contributions. But now we are saying with the new NSSF regulations, that is the enhanced NSSF that we are talking of tier 1 and tier 2, there is a portion that you can be able to access even before retirement, provided some preset conditions are met.
Right. Thank you, Josephat. So we have Wangari asking, kindly explain briefly how digital services are taxed, like in the case of content creators or consultancy services online. And I think I can combine that with another question from Jay, who is asking, how can you claim or get refund of VAT from KRA, which is in credit and increasing with client 2% withholding payment?
So on professional services and digital content, that one now it's a matter of assuming you're an individual, you need to put that in your income tax return, ensure that you pay taxes on the same. Again, if you exceed the VAT registration threshold, like that's assuming you are resident, then you need to subject the same to VAT. My colleague will add that.
Oh yeah, there is also the issue of digital content monetization. There is a holding tax to that effect, where the rate is at 5% for the content creators. Then on the other issue of VAT credit that is increasing as time goes by, there is the 2% withholding on VAT that your clients, if you are VAT registered, then your clients will be withholding the 2%. So if you are in a credit position, then this would continue building up your credit. So what would happen is you are allowed to apply for VAT refund from KRA. They'll give you a refund in terms of money, or they'll give you a voucher which you can be able to utilize to offset other taxes, be it PAYE, be it income tax. But now what you should note is there is a time limit upon which you are supposed to claim this refund. Currently, it's 24 months. So if you don't claim that refund within 24 months, then it will continue on getting hold up, because you can only again use it to offset future liability output, but you cannot be able to apply for a refund from KRA. So you should be very much constant on the timelines.
Great. We also have an anonymous attendee who asks, I understand that persons with disabilities have tax exemptions. Is that on earnings as a consultant, which is in this case exemption on withholding tax up to a certain amount? Yeah, so maybe you can also speak to tax exemptions for persons with disabilities.
Yes, then there is an exemption of 150,000 Kenya shillings. But now the person needs to have that exemption certificate, which has to be approved, because when you be it personal income, look at this case where you are earning consultancy income, or when it comes to employment, because the employer will need that exemption certificate reference to declare in the when submitting the pay as you earn declarations, because that 150,000 Kenya shillings will now be declared as an exempt. So for the employer to declare that accordingly, then he would need the exemption certificate. So exemption certificate is key.
Right. Thank you. Thank you so much, James. So our time has unfortunately come to an end. I'll just allow maybe closing remarks from the team. So James, Nzioka, Josephat, do you have any closing remarks as we close the session today?
I think we also delighted to have met everybody on and to engage on matters taxes. We know it is a very broad topic that cannot basically be depleted in 2.5 hours like we've done today. So we've just had a nutshell of it. And even as we had mentioned in the beginning, it is a dynamic field that will see a lot of changes coming year in, year out. So just thanking everybody in the DTB team. And from our team, we also had Alisa Kambie, who is on the background answering the questions that are coming through the Q&A. So we also are thankful for what she's been able to do on that. I think we are grateful for the opportunity of this interaction.
Thank you so much, Josephat and team. I think even from the comments that we are receiving is that this was very insightful, and I think it has really empowered our participants on how best to go about the tax matters and even the current affairs. So thank you very much, and thank you, ladies and gentlemen, for sitting through the session and the engagement. We've had really good engagement. So thank you. We will continue with the next module next week, same time, same place. So looking forward to hosting all of you. You will receive an email from Zoom with the sessions, the previous sessions as well as this session. And please note that for recordings, for those that you will not be able to access, we will give a link in the website, in the DTB website at the end of the program. So stay tuned for more sessions coming your way. Thank you, ladies and gentlemen, and have a good day.
Good.